Good afternoon or morning, wherever you may be. This is Andy Harleman from JMT Consulting. We are right at the top of the hour here, but I always like to give about a minute or so to let other people get logged in. So if you hang tight for just another minute or so, we'll let the last minute people who are maybe logging into the GoToWebinar get started. So hang tight, we'll be back in about 1 minute. All right. Once again, my name is Andy Harleman. I'm with JMT Consulting, and we are just so excited to have Neely Duncan from BKD with us today to present on tips and tricks for the implementation of the new nonprofit financial disclosure and reporting standard. You know, this webinar may go over the allotted hour due to the significance of the topic. So if you can't stay for the whole hour, we understand that we are actually going to record this, and that recording will be available to you. So don't worry about that. I want to tell you first about JMT. We are sponsoring this particular webinar, and ask that we move to the next slide. JMT Consulting Group is actually an independent firm that works exclusively with nonprofits, primarily in the area of helping nonprofit organizations implement new ERP and financial management solutions. So there are a lot of providers in the marketplace. There's a lot of great software out there, but you're not going to find another firm like JMT that only works with nonprofits and has a national focus like we do. So we're an independent firm. We work with a lot of different software, including the ones you see on the screen here. Ultimately, we are here. We were founded by a nonprofit finance professional 27 years ago, whose entire mission was to start a firm that could be objective and could really be focused in on nonprofits. And so that's what we're all about. And we're very happy to have you here, and very happy to have Neely as well. And a couple of minor housekeeping things before I turn it over. If you have any questions during the webinar, please submit the question in the question box on your control panel. It's sometimes hard for the presenter to see that because it's just a very minor little flashing thing on the screen. So we will get to the questions, I promise you. We also are going to have a few polls throughout the webinar for you to participate in. And we are going to send the slides from this webinar out to you at the end of the presentation. And then finally, there is a little thing on your GoToWebinar. It's a little different than some. Most of you should see like an orange arrow at the top left of your control panel. If you want to minimize the window so it's not taking up too much screen space, that's how you can do it. All right, well, finally, and most importantly, I would like to introduce our friend Neely Duncan. Neely has more than 18 years of auditing experience in public accounting with a particular emphasis in nonprofits. And her responsibilities include planning, risk assessments, and completion of audit procedures. You know, she supervises staff, reviews work papers and financial statements, and attends board as well as audit committee meetings after the completion of the audit. And most importantly, she's also a highly sought after national speaker. I could tell you that JMT was first introduced to Neely from one of our clients, a very well-known national nonprofit based in the Dallas, Texas area. The CFO of this organization basically said, hey, you need to get to know Neely. She chairs our nonprofit CFO group. And indeed, Neely has been involved with the Dallas CPA Society not-for-profit study group as co-chair or chair for some 15 years. And so we took our client's advice and we reached out to Neely, and we immediately recognized a synergy based on our mutual passion for nonprofit organizations. And in fact, earlier this year, we were very honored to have Neely present at our exclusive Innovate conference for nonprofits. So I can tell you, I'm sure that I can speak for Neely when I say that speaking at JMT's conference was no doubt the highlight of your illustrious career. So we appreciate that very much, Neely.
It was. It was. I dream about it, and I have good times thinking about it every day.
Very good. Well, without further ado, I give you Neely Duncan. Neely, thank you so much.
All right, guys. So we are going to talk about what I have learned implementing and instituting this standard on several clients now, and just kind of help you with some tips and tricks. I did go ahead and leave quite a bit of the detailed information in the slides just as a reference point, but this is more about what I've learned about the implementation, not about the standard itself. So a lot of this is going to come through that. I really highly encourage you go to that question box on the GoToWebinar screen and ask any question you want. I'm going to try and keep a really good eye on it. So I want this to be as interactive as possible for you so that you get the most out of it. Okay, so let's go. So Melissa, can you launch our first poll so we can get an idea of who's in the room? Okay, so what is your role? All right, looks like we got over 90% of you there. So the majority of you are in the CFO role of your organization, over 70% of you. So I am going to really focus in on that area. Sometimes when I do these type of things, I get public accountants, I get CEOs, I get board members, I get all different kinds of people. And so this will help me tailor it to more accounting-like, since we have mostly CFOs in the room. So let's talk about the standard just from implementation requirement. The first thing is that it's effective for financial statements for fiscal years beginning after December 15, 2017. So what that means is that if you have a December 31st year end, then you should have started implementing the procedures necessary to capture the data for the standard as of January 1st, 2018. As your fiscal year end starts, so if you're 6/30, you should have started implementing processes and procedures to implement this as of July 1st. If you're 9/30, 10/1, that's right around the corner. So let's see if we can help you through this, and hopefully one thing that I have really recommended to many clients is that to have a 1 year only presentation if you can. If you're not able to, for contractual reasons or something like that, then you can't. But there's no reason in a lot of cases you can't send last year's financials and this year's financials. Because if you show comparative, then you're going to have to go back a year on all of the disclosures and requirements, with the exception of, on this slide, the analysis of expenses and the liquidity. But everything else you're going to have to go back and retroactively show for comparative financials. So my tip for you on this is do whatever you need to do to show single year financials. Okay? All right. This is just a slide of why the FASB is doing this. A lot of times at board meetings, I get questions of, well, what does this mean? Why are we doing this? But it really is, according to FASB, which is the Financial Accounting Standards Board, which are regulators for how the financials have to look, is really about transparency and liquidity, and financial flexibility is where I see this kind of going towards. When you really look at the disclosures, that's really what's going to be different and highlighted. And there's just going to be a lot more detail, and they were trying to make it more readable and understandable. So Melissa, can you please launch our next polling question? Let's figure out how far our audience has gone to prepare for the changes. So if you can, thank you guys for doing these polls, by the way. This really helps me tailor the presentation to the audience. So All right, it looks like we have about 80% of the audience that has not gotten about halfway. So this will be good to know how to go in much detail for this. This is just a summary of all the changes that are coming. We're going to go into detail about that. When you see the word enhanced disclosure and an accounting standard, that means there's going to be some more work and requirements in order to get that. And if there is an enhanced disclosure from an audit perspective, so the other thing to kind of let you know is I actually serve as in my job here, I'm 50% audit and 50% consulting. In my consulting role, I serve as I being part of BKD, serve as the CFO in many nonprofits where they outsource it. And so I've had to implement it as the CFO, and then I've had to audit it as the auditor. And so I'm going to try and help you understand why and how much work it's going to take to do from both perspectives. But basically these enhanced disclosures, because there's a requirement to have this disclosure, then that means the auditor has to audit that disclosure in order to opine on the financials being materially correct. Okay. All right, the statement of financial position. Basically, not a whole lot has changed here. They did not require a classification, a classified balance sheet. So if you're a healthcare nonprofit, you're probably still going to do that, and you'll follow the healthcare audit guide. But then some of these will follow into you as well. So the major thing that changes here is that when you get to the bottom of what used to be unrestricted, temporary restricted, and permanently restricted, those classifications have now changed. Okay, so now those classifications are without donor restrictions. And Melissa, it looks like we have a problem where the slide is stuck. Did you close that poll?
Yes, I am working on it.
Okay.
The poll is closed, but we're having some difficulty, so I am working on it. I apologize to everyone.
Okay.
If you want to keep going.
Okay.
We'll make sure that everyone gets a copy of this as well.
Okay. So with the statement of financial position, which is otherwise known as a balance sheet in the for-profit world, we've gone from 3 classifications of net assets to 2. And then if y'all will just let me know when the screen is unstuck, then I'll start referring back to the screen. So now we're going to have to show with and without donor restrictions. And with donor restrictions are going to include all of your temporary restricted and permanently restricted. And then without donor restrictions are still going to include your board designations and then anything undesignated. Now the key to this is, yay, the presentation is going to look better on the face of the financials, but the problem is that there's actually more disclosures required around the different buckets than we had previously. So we're going to go into that a little more, and you really got to think about what you're going to have to do with your system. I've had one client that had to completely change their chart of accounts to pull the information in the way that was needed. So it's just really going to depend on decisions that we make up front. As far as the statement of activities, instead of the 3 columns, you're now going to have 2 with and without donor restrictions. There's also going to be a requirement in investments that you are required to make that net of actual direct expenses as well as an allocation of salary for strategy of investments. You're also going to be required to break out the detail expenses by program. And we're going to talk a little bit about the major program determination. Whatever it is you decide from the major program determination is what's going to have to then be replicated throughout all the footnotes and financials. So it's going to be really, really difficult from that perspective to kind of make sure that you are going to implement everything that you can as efficiently as possible. So you're really going to have to get other people in the organization involved, and it's not really an easy process. And I think sometimes people think, well, it's just a financial disclosure or presentation, you know, but what people aren't considering is you may not track that information. And if you don't track that information, how are you going to come up with a disclosure? So that's the problem that people are encountering. That's kind of my tips and tricks for that, is that we really got to focus in what we can capture today and what we can't. And we need to make sure that we have that stuff really detailed out. So let's talk about what the investments are. Okay, the investments, if you have investments, then you are required to show investments net of expenses. Now these expenses, you're like, oh, well, that's no big deal. It's just the fees for the third-party advisors. No, it's not. It also includes any salaries, benefits, travel, and other costs associated with the officer and staff responsible for the development and execution of investment strategy. Okay, not the accounting for the investments, for the development and execution of the investment strategy. So one of the things that I learned when implementing this is really thinking about who is involved in the investment strategy, how much time does that person spend dealing with the investment strategy, and then how are we going to allocate those costs to be expenses in net of investment income. Okay, so it's also going to be the allocable costs associated with internal investment management and supervising, selecting, and monitoring investment management firms. So a lot of nonprofits do not manage their own investments. They kind of outsource that to other wealth advisors and that kind of thing. So those fees you're paying in association with that are going to be part of this net number. So you're not allowed to put that in into the picture of.
Neely, I apologize for interrupting you, and I apologize for the technical difficulty that we're having with the GoToWebinar program. Can you try closing out of your presentation and relaunching it?
Sure.
Stop sharing, and I can let you share again.
Stop showing. Let's try that. Is that working?
Yes. Can everyone else see this? Raise your hands. Okay, we should be good.
Okay. All right. I don't know what happened, but there you go. So with the direct internal investments, be sure that it's not the accounting for the investments, that it's about the strategy and execution of the investments that gets allocated out. It's going to be better for you to allocate this out based on the changes in the requirements for management and general expenses. And every nonprofit that I've implemented, their program percentage has gone down based on the clarification guidance on the allocation of expenses. So we'll talk about that a little bit as well. The other thing here is this is just an example of a fairly small nonprofit that how we came up with and removed investment costs based on how much time the employees spend on strategy and execution, and a real easy kind of simple thing that you can look at. The other thing is that losses are not going to be required to be on your functional expenses. So you want to make sure that if you have any of those things that are listed in the examples or anything that's considered a loss, then that will not affect your program G&A and fundraising percentage as well. Now on the statement of cash flows, there's really been no change other than if you do the direct method, you can eliminate the additional reconciliation. But other than that, really nothing has changed. That's going to be in phase 2 according to FASB. And you know, the big part of this standard that requires, in my opinion, the most work is the program service determination, which we're going to go through. Do we want to launch a poll, Melissa? Now I'm afraid.
We can try it one more time.
Okay.
And if not, we'll just skip them. So I'm going to launch it.
Okay. Okay, so it looks like about 40% have done nothing related to program service determination, and the rest, and about 40% done more than one of the items here. So I think we're about split last. So I'll try to cover both from if you have implemented, did you consider this? And if you haven't implemented, then here's the things to consider. Okay. This includes all nonprofits, including trade associations, including churches, including everyone. So whether or not it's required for the 990 has no impact on if you need financial statements in accordance with GAAP, then you're going to have to do it. The program services. So I want us all to think about what we do. What do we do in our nonprofit? And how and what are we going to show in our financials now? Because we're required to. We're required to show what major programs we have, okay? Now, every example in the standard shows 3, but you could have 1, you could have 6, you could have 2. I have gotten that answer from FASB that says, hey, you know, it's really your major programs. So here are some factors to consider. You can look at the program objectives. You can look at the budget, how you budget. Do you budget by program? You can look at maybe you have certain grants for certain programs. Like, there are all different kinds of ways you can determine what the major expenses by program are, but you're going to have to show them by program now. Okay, so think about that for a minute. You're going to have to show the major programs, and then you're going to have shared expenses between those programs that are going to have an allocation. And you're also going to have to show it by natural expenses. So salaries, insurance, blah, 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 by program. So keep in mind that we really have to think through what we're going to determine as our major programs, because you'll see this will impact so many of our decisions going forward. Some of the things that I do as an auditor to get comfortable with the major programs you've selected, I look at what are you soliciting for? What does your website say? What did you put on your 990 as what you do? Annual reports tend to show everything that you do. Some organizations are having like program 1, 2, and 3, and then an other column for all their others. And I'm fine with that if I put on my auditor hat, as long as the other column's not, you know, a significant amount of expenses, meaning like 60% of all expenses or something. Really, where they go back to is the segment reporting guidance in the standard, and typically segment reporting for consideration of a segment is 10%. So if you have a program that's at least 10% of expenses, then you probably need to consider if that needs to be a major program. That doesn't mean that every program that is greater than 10% needs to be there, but that's where I would start in the consideration. From a financial statement perspective. Now, there may be programs where you group them together. So for example, I'm the CFO of a homeless shelter. where they outsource their accounting function to us. And in this homeless shelter, they have a men, a women's, and a family wing in this shelter. And so we tend to track that internally between the men versus the women versus the family, because there are different grants for different groups of people. But on the financials, we're just going to say shelter operations. We're not going to delineate between the groups. But then the shelter also has a thrift store, right? And then the shelter also has transitional housing. And then the shelter also has a foundation. And we just went through a capital campaign, and we just drew on debt and created a debt area where we needed to leverage the campaign pledges, and anyway, all these different kinds of things. And so I really had to sit down and think about what matters to us from the perspective of what we want to show the public. We really have to think about using this as more than just accounting. We have to step outside our accounting brains, and we have to say, how can we use this to market, to get grants, to get the public interested in us? And I guarantee you it will make a difference. Here are some examples. You could be, maybe you are a university. One area is student instruction, research, patient care, other. Maybe you're a religious organization. These are just examples. American Cancer Society always puts their financials on their website, so I looked to see what they picked. And just really sit down and think about the mission of your organization and what you want to show. So functional analysis is really going to be between program and supporting services. And here I have top 3 programs, but it's just because that's what the example was. These are just extra slides for you to consider in this, because I really want to go to where we get into the nuts and bolts and the things that I've learned. The other thing is, don't forget about your 990 expense categories. If you do have to add different line items, don't forget you're still going to have to break these types of expenses out on your 990. And so we're going to get into exactly what is happening and changing for the functional analysis, okay? The first thing that is changing is that it has to be considered direct conduct and direct supervision to be a program expense. This is a huge impact that people are not realizing, because we used to allocate a lot of things based on head count, or how much of the expenses went to program versus this, or whatever. But these are related to the salaries. Okay, this has to do specifically with the salaries. And if it is not direct conduct or direct supervision, then it is no longer program. And so we're going to go through these examples, because I want to make sure that you're very clear on this so you don't get dinged on your audit, okay? Oh, and then we have a question. Colleen asks, how does the program services differ from the statement of functional expenses that we already prepare? So the difference is, before, the standard kind of recommended that you break it down by program. Now it's the requirement. So people would have program, G&A, and fundraising, but they wouldn't have program A versus program B versus program C. And now you have to have program A, B, C, or however many major programs you pick. So the detail, it's the detail of the program services. Now, if you already did that, then you're a step ahead. Then you're just going to have to change any methodology that they've clarified in the guidance. So I hope that answers your question, Colleen. If not, ask me another one. I love questions. So the first example that's in the standard, and this is an example that's in the standard. Okay, so this is not Neely's interpretation. This is directly from the standard. But basically, your CEO, a lot of times people would say, oh, well, the CEO spends this much time, over program people and spends this much time cultivating donors and then this much time just on basic administration. And, there really wasn't any rules that says you couldn't do whatever methodology you want to do, but now there are, okay? And so unless the CEO is directly supervising the program, their time is G&A. So an example that they give in the standard is if they're directly involved in the research, if you're a research institution, if they're directly involved in the research, then that would be a program expense. But just to be the CEO of an organization that does research is G&A. Okay, another example that I went through with one of my clients, because I have quite a few private schools, is the headmaster, when he teaches a class, is program. But just because he supervises teachers doesn't make it program. Okay, so we have to really think through what the CEO is doing. And when you're doing your memos for your auditors, you really want to get in there and talk about direct conduct and direct supervision to kind of keep them off of you as much as possible. So I actually go in and implement this standard on several clients for their auditors, like they have different auditors than us. And so every situation is going to be different, but you can't assume just because the CEO is over so many program people that makes it program. If they're involved in the actual decision making of the programming, then that could be program. So a lot of times they'll have the program director do everything related to the program, and they just, the program director says, hey, CEO, we want to do this, this, and this, and the CEO says yes, and that's it. Well, that is not program expense anymore, okay? And that is a big change, because a lot of people would allocate expenses for the CEO to program just based on how many people in the organization there were. The CFO's time is all G&A. It is all G&A. The CFO time is all G&A. Unless for some reason you have a CFO that actually carries out a particular program, it is all G&A. So a lot of times what they would do with the CFO function is they would say, hey, we're going to allocate the CFO's time based on the accounting that they do for different types of programs, or maybe by head count, or some kind of percentage. You can't do that anymore. It is all G&A unless they're actually part of a program. And so the other one that they have in here is the HR department, all G&A. So a lot of times before, people would allocate the HR department based on head count and say, well, the HR department helps this amount of program and this amount of GA and this amount of fundraising. You can't do that. It is considered a supporting service, and it's supporting activity for the entire entity. Then it is a G&A expense. So you can see how your things that you may have put in program are now moving over to G&A, okay? So you have to really think about this piece of it. Grant reporting, they have specifically said is G&A. Okay, the only difference is if it's a scientific report, then that can be program. But if it is accounting for grants, and if it's grant reporting, if it's a fiscal report, if it's any of that, it's not program anymore for the purpose of GAAP. It still may be chargeable to your grant based on what the budget line items for your grant are. So we serve as the back office grants compliance department for several organizations, and so each one is a little different. And sometimes, as you know, at least in my experience, some grants allow volunteer hours as a match. Well, GAAP doesn't allow volunteer hours unless it's a professional service to be recorded. And so it creates almost a separate set of books that has to be trued up at year end before your audit. This is going to create some of that as well, because maybe you want it to be allocated to that grant because that the budget says you can pay for this much, but you're going to have to fix it at year end because it cannot be it cannot be in program when you get ready for your audit. And so here is just a really simple example. So you have program A, you have program B, you have program C, you have G&A and fundraising. And so they don't have any limit on this as far as how many you need to have, but I would be looking at that 10% rule again and really make sure you're comfortable with that. Okay, so we got some questions. All right. Where do you draw the line with direct supervision? Do they have to supervise those engaged in the program work? Right. So, like your department, your program director, they're going to still be considered program for the majority, except for normal administration stuff they do, right? But they're directly supervising the program. Your CEO is not directly supervising the program in most cases. Usually there's someone else that is supervising the people carrying out the program. So that's the best way that I can say that FASB has asked. But another thing you can do, Steve, is you can email me. My email was on that first page, I think, or third page or fifth page, I don't know, somewhere over there. And tell me your specific situation, and I can ask FASB exactly how they would rule on it without telling them your name or your organization. I'm happy to do that. I do that for so many people. It's like FASB's like, what are you doing to me? But they love me because I just keep asking them questions, and we're trying to get everybody to do things the same way. One of the things that people get really annoyed at is that the industry is not up to date on this, meaning your watchdogs and charity navigators and the public and things like that. I'll tell you, here in Dallas, I'm working with a United Way group of Denton, and they're really even considering changing the grant applications to be more outcome approach instead of forcing a certain percentage of program G&A and fundraising. So I think it's just going to be a slow movement to get people to change their focus, but unfortunately, most of the expenses that you had allocated to management in general that are overhead or that were allocated to program are probably going to end up in management in general. Another one that I get asked a lot about is an IT department. So if your IT department, let's say you're at a private school again, let's use this example, and part of your time is spent with the iPads of the students or something to that effect. Well, that's program, right? That's part of those educational activities. Or maybe they teach a class, that's educational activities. But the hardware, network, all the other kind of things that go along in the IT department, that's considered a supporting service. It is not program. I did also get an answer on a type 3 supporting organization that is for the purpose of raising funds for a governmental entity. Would those payments to that governmental entity be considered program? And the answer to that was yes. So there are all different kinds of scenarios that have come up. I'm hoping y'all think of other questions. And then Rob says the department director of each program would be a program expense, right? Yeah, I think so. I think if you have somebody that's solely focused on one program or on certain programs, I think a little bit of their time might be G&A, just for administration purposes because they're a director, and so that with that in management comes administration. But I think for the majority, it's going to be program. It's that overhead people that are causing the problem. If you have a COO, a CIO, if you have a CEO, if you have legal counsel, if you have HR, IT, all those things are considered supporting service. And so it's not that the program could survive without it, but it's considered a support service, and they clarified all that in the new guidance. So make sure you know what kind of impact this is going to have on you, because a lot of grant funding can be based on what your percentages are, and I don't want you to be surprised or taken off guard for that. The other thing is you're going to have to get more detailed in the disclosure. You're actually going to have to break down the qualitative reasons and how you came up with your allocation. Now remember, those items that we were talking about were really related to salaries, but you can still allocate like insurance, repairs and maintenance, depreciation, all that. You can do that on square footage. Maybe you do it on head count. Maybe you do it on expenses, direct costs. Maybe you do it some other way, but whatever way you pick, you're supposed to stick with, or it's considered a change in estimate in some cases. So you know, since everybody's going to be redoing their financials, reevaluate and take the time to think about everything that you can allocate. It might be worth it now, since there are a lot of things that we used to allocate based on a reasonable methodology that we cannot allocate anymore. And so I will tell you, most people put all those ancillary expenses, such as like we talked about, insurance, supplies, repairs, depreciation, they usually do that with a square footage. I often see things that are allocated that are bucketed, but people are trying to really take the time to directly identify the expense on the front end, and that will help you on the back end. So if you get an invoice, for example, for supplies, and you know that X supplies went to this program and X supplies went to that program and X supplies went to this program and X supplies were for administrative staff and X supplies were for development staff, you just code it that way on the onset, okay? So we really, really, really have to think about what that means. And one of the things that was in a study that I read, and I can't remember which one it was, but you know, there was some real concern about nonprofits that had no G&A and no fundraising, especially if they had contributions, because it's not possible to run a business without some form of administration, typically. Okay, either they're not recording their donated services, or they're not properly allocating them or considering the allocation. So that's kind of some of the things that have come out and why people started looking at this. So with that, we're going to see what the net asset disclosures are. Now, like I told you, I added a lot of slides in here for you to refer back to. I hope you find that useful. I definitely love JMT. They have implemented the accounting system on 4 of my clients now. And my clients typically, I hear nothing but complaints when it comes to implementation, and I've heard nothing but great things. So I'm happy to help their clients any way possible. So net asset classification. So remember, I told you, even though we have with and without donor restrictions, we still have additional buckets that we now have to disclose. We have to disclose assets that must be for a specified purpose, preserved and not be sold, assets donated with stipulations, and you also have to break out the perpetual in nature. They don't want you to use permanently restricted, they want you to use perpetual in nature, so you still have that disclosure even though that column disappeared on the statement of activities. You also have to break down what's left in your net assets by your major programs. Okay, so if you pick 10 programs to show, then you're going to have to break down your net assets by 10 different buckets. So it's going to be better to have less programs or really focus on the largest programs if you can. Investment for a specified term, use in a specified period, and acquisition. So look at this. This looks like a statement, doesn't it? Oh my goodness. Auditing this is tough. Not to mention putting it together when I'm on the CFO side. But looky here, we have program A, then we have these areas. We have program B, then we have these areas. Then we have program C. So in this case, like I told you, these examples have 3 programs. Then we had to break out things that were given to us for buildings and equipment. Then we had to break out annuity, trust, and split interest agreements. Then we had some that haven't passed in time, so you know those are our multi-year pledges. But then look at this, guys. You have to break out your permanent or perpetual gifts by program. So if the perpetual gift was for a particular program, you have to break that out. Plus, you have to break out if it was just for anything, but it was perpetual. A specified event, and then not a subject to appropriation, but is for land that's required to be used for a particular thing. Okay. Here's another example of one that we implemented. You'll see here, this one was relatively simple. They had a few endowments that were perpetual. They had specific program and support activities endowments, and then specific future periods. The release, so before on the release of restrictions, we used to have purpose, time, or both. That was it. Now you have which program and did you satisfy it? Did you buy equipment? Was it time? Was it a change in an unconditional promise to give? Or was it an appropriation from an endowment? So there are more categories you have to have tracked to capture this information on the releases. And that is a required either disclosure or on the face of the financials. You have to break it up into those new buckets. Okay, so here is an example. Purpose restriction accomplished, program A, B, and C, right? So this is the release. Program A, equipment acquired and placed in service, time, release of endowments, with and without purpose restrictions. So remember, you can have board endowments that are without purpose restrictions, right? Because if the board is endowing it, then it's considered undesignated or without donor restrictions. The only thing that can be in the with donor restrictions is if the donor says. But if the donor gives you $1 million and the board says, then that's without donor restrictions because it's the board that's restricting it. So that hasn't changed. It's just now you have enhanced disclosure requirements related to the board and management designations. You have to really think about how these board and management designations are going to impact your financial statements. And they will also affect your liquidity disclosure. And you're going to have to give a description, the types of things that they're designating or appropriating, and what the qualitative and quantitative information is regarding board designations and appropriations. So this is something that was pretty loose before. I mean, it was recommended and you probably should have shown it, but a lot of people just didn't. Now there's required disclosures, there's required categorization. All of that stuff is going to be something that you're going to have to deal with going forward. Here's just a real simple example of a board designated endowment and a liquidity reserve. Here's an example of an operating reserve and a strategic growth reserve from the board. And I do have other examples. If you want to email me, I'll be happy to share those with you. But these are just the ones that we show in here because we only have an hour together. And I'm trying to get done so I can answer some more questions that you might have. Now this liquidity disclosure, this is the one, guys, that you have to go calculate on your most recent set of financials, because this can look really bad, and you have until the end of this year, if you're 12/31 year end, to handle that, to change it, because the board can change their designations at any time. And so it's really important that you go calculate this, and I'm going to show you how to calculate it. So you're going to have to consider any external limits imposed by donors, grantors, laws, contracts, and then the board limits. Okay, so let me show you what all this means. For contractual limitations, you have to really think about, do you have any restricted cash or assets set aside for debt agreements, self-insurance, collateral arrangements, reserve requirements, charity annuity agreements, split interest agreements, beneficial interests. Those are all things that I keep seeing pretty common. So the first thing we have to do this calculation, which is exactly what you need to do on your most recent set of financials, is that you have financial assets at year end. What are financial assets? Well, financial assets are those things that will be converted into cash, is the easiest kind of concept that I can think of. So, for example, cash, investments, receivables, interest and endowments. It's not going to include prepaid, right? Because you already paid the cash. We're just amortizing that. It's not going to be building an equipment because we're depreciating that. It's not going to be deferred revenue, right? Because we've already gotten the cash. So these are those financial assets that we need to look at and evaluate and determine what of our financial assets are actually going to be available for the next 12 months without any restriction or designation. Okay, so there we go. So we calculated the financial assets. You see that 27 million at the bottom. That 27 million comes up here at the top. And then we start backing out those things that are unavailable within 1 year. Okay? That are that are going to take away, that we're going to have to pay or due within 1 year under any kind of internal designation or contractual obligation. So you're going to do the bonds that mature in a period of time greater than a year. You're going to do the restricted by donor for perpetual purposes, the restricted for time, subject to appropriation, and then looky here, the board designations also go here. So if you got a board designated happy board, it can actually make you look like you have no assets available to meet the needs of the organization for the next year. So it's very, very important that you have a good understanding of what this is going to do to you and what it's going to look like, because you don't want to get in a situation where the board can't change it now and they've designated so much stuff that it looks like you have zero assets at the end of the year. So really, really think through that. Really, really think through that. The liquidity disclosure, you can also show it this way if you don't want to show the stuff backing out and that kind of stuff. But I'll tell you that everybody pretty much is doing it this way because it's just easier to calculate. But you can show it either way if you know. So of the financial assets, you know, this is what we have in cash. This is what's available in what we're going to get in receivables. This is what we're going to get in pledges, that kind of stuff. Okay. Endowments, before you used to have to move the funds from the unrestricted column. Now it's just basically that you can make those changes if you have an underwater endowment fund in the fund that it happens. So you're going to have with and without donor restrictions, so they made it a little bit easier on that. So before, you used to have to show a negative over here in this without donor restriction when you had an underwater fund, but now you just have to disclose it. You still are required to track endowments by endowment. That doesn't mean you can't collectively invest them, but hopefully that will help in the years that if we have to experience any kind of underwater assets. The fixed asset changes, I've never had a nonprofit use the other approach, but basically you did have an option that you could release the restriction of an asset as it's depreciated versus when it was placed in service. Now they're saying it has to be the placed in service approach. Okay, so that's usually what everybody does anyway. So let me look and see what questions we have, and I know it's been fast and furious, but I wanted to give you as much of the tips and tricks that I've learned over the last several years in dealing with this standard, because it is the largest change to nonprofits in over 20 years. And I don't think people are really ready to on how much work and time and effort and thinking it takes to get through it. So even just the program determination is pretty intense. And so let's see, Mary, we have camps for girls, no outside use. Is any expenses of maintaining and running the camp not considered program? Well, I'm assuming that the camp is part of your mission. And if that is, and holding a camp for girls for whatever part of that mission is, then yes, that would be program. If there's any kind of overhead or advertising for that, then that might be fundraising or G&A. Ancillary type supporting services of the camp could be G&A, but actually running the program and using the facilities and maintaining the facilities and all of that kind of stuff is going to be program. Are general expenditures excluding your main mission? Most of our funding is restricted for our mission. Most of our funding is restricted. I'm not sure I understand the question completely, but what I think you're saying is that if you have most of your funding is restricted to one part of your mission, yeah, I'm not, oh, for the liquidity disclosure. Okay, I'm trying to make sure I understand. Yeah, so if a donor is restricting the money for one of your missions or one particular part of your mission, then that still is a donor restriction, because they can restrict it for a program or time or purpose or whatever. The rule in the accounting literature that says if you receive it and spend it in the same year, still you can have that policy as being without donor restriction. But yeah, I think if they're restricting it to a particular program, then it's going to affect your liquidity disclosure, because it's not like it's available for general expenditure. And that's what they're trying to get to. What money is available just for general purposes and has not been restricted or some kind of contractual limitation by someone. Let's see. I work at a theater. The artist director is the top employee, CEO. He will direct shows, which would make sense as program. Yes, I agree with you. But he also determines the artistic direction of the theater as a whole, finding new work, etc. Would that be program? I think if he's acting as a program director, then that's program, right? I mean, he's doing the work of several levels that some nonprofits have. It doesn't sound like you have various levels to help in that process. Now, if he's trying to get donations, that's fundraising. And then the time he spends not directly involved with the programming of making that programming work, like a director would, like a program director would, then yes, the rest would be G&A. So I think that might be helpful there for you. And then Lisa, what is the definition of general expenditure for the liquidity disclosure? I'm not sure that they have that defined. That's just, let's go back and see what they say here. As part of the liquidities management, it has a policy to structure its financial assets to be available as its general expenditures and obligations come true. There's not a definition there. Financial assets available to meet cash needs for general expenditures within 1 year. Yeah, I don't remember seeing an actual definition, but that doesn't mean there's not one. But I know that they're trying to get to a number that has no kind of restriction or contractual obligation on it. So hopefully that helps. If not, if you have a very specific case or question, you can email me and I'll ask FASB myself. I don't care. I don't mind at all, because I love doing these seminars and stuff because I learn more too and I can better help the community. So with that, I think feel free to take down my name and email. Feel free to find me on LinkedIn. Whatever I can do to help you, I'm happy to do that. And then with that, Melissa, I don't see any other questions. So I think we're going to end right on time.
Yes, thank you so much, Neely, again. And we apologize again for the technical difficulty that we had. We will send everyone a copy of the presentation deck so you can see the slides that you missed out on. And we thank everyone for attending today, and Neely again for your time. And we will see you on our next webinar.
All right, y'all have a great day. Bye.
Bye-bye.